Hi everyone, I'm Chad Shoop, the editor of Automatic Profits Alert. And when you look at our economy right now, the US economy that is, it's really firing on all cylinders. And a lot of people look at that and they think it's a sign that bad times are right around the corner and that we're about to enter a recession, probably even a stock market crash. And one of the key statistics that everybody's pointing out right now is that unemployment is below 4%. And the last time this happened, we saw the stock market roll over. So I have a chart that I want you to look at today. Now, when you look at the chart, you can see that the solid green line is the stock market. That's the S&P 500. And then the blue dotted line going up and down very sharply is the unemployment rate. And then there's also red dots on the S&P 500, and that indicates whenever the unemployment rate is below that horizontal 4% line on the chart. So it's just a great visual for you to quickly see when unemployment is below 4%, it's usually near market tops or at least a market correction. And in this chart, you can see that back in the 2000, 2001 period, that the unemployment dipped below that 4% line. And sure enough, almost on cue, the market rolled over and we had a decent crash. But, and as I'm going to point out in this chart, just because the unemployment is below 4%, it doesn't mean that the good times are set to end. Just like that the bull markets, they don't die from old age. Well, the unemployment rate being too good doesn't mean that it's automatically going to end or lead to a recession right away. It can get even better. You can go back and look at the mid-60s where the unemployment fell below 4% and then continued to fall and fluctuate under that 4% mark while the S&P 500 steadily climbed higher. Eventually, unemployment reacted and jumped higher, and then we went into a recession and a stock market crash. So inevitably, this low unemployment rate is going to jump higher and it is going to lead to a recession. But it doesn't mean it's today, tomorrow, not even next year. It could be several years away, like in the mid-60s, where that was a good 4 or 5 year period that the market kept rallying. And you can go back to the early 50s as well and look at another example where the market kept rallying for a good probably 5 years there while the unemployment rate was extremely low. And when you look at our unemployment rate right now, it's around 3.9%. In April, it dipped to 3.8%. So we're clearly below that 4% mark on the chart that had all those red dots that people are using to try to spook you into selling at this time. But don't let it alarm you. Now is not the time to sell. This market can rally for several more years. As I mentioned last week, the bull markets don't die of old age, and that I expect at least 2 more years of a strong euphoric rally here as we're in the late stages of the bull market, but I don't think it's over yet. And you can follow all of these indicators, though, as times on when to get out of the market. When unemployment starts to spike, that's going to be your warning sign that, hey, this economy is starting to be overheated and it's retracting some. We're in a recession. It's time to reevaluate the strategies that you're using. But until then, until that unemployment rate starts to jump higher, it can fall much lower or stay steady for several years. So you don't want to exit just yet. You want to stay in this market and continue to benefit from this historic bull market rally. Well, that's all for my video today. If you enjoyed it, be sure to subscribe to our page and continue following us. Until next time, I'm Chad Shoop with Automatic Profits Alert.